everybody, I'm John VanDuzer, CPA and partner with the James Moore & Company, and I'm here with Kyle, CPA and one of our talented tax managers. And we are going to start our 4-part series for our real estate industry update, and we're going to cover how to calculate the tax on the sale of real estate. So Kyle, thank you for joining us.
Thank you, John. I appreciate you having me. And there's nothing more exciting to talk about than the sale of real estate. So great way to spend my day here.
I can think of one or two things that's more exciting than calculating taxes, but that's for another video, I guess.
We'll get into
so as we're going through this, we actually we're going to use some slides today. It's just easier when talking about math to have things on the screen. So Kyle, why don't you talk us through how do you calculate? We kind of say to calculate taxes, you need to first calculate what your gain is, and then you need to figure out what taxes or what the character of that gain is on the flip side in order to understand how much taxes you owe. So why don't you walk us through how do we calculate the gain on the sale of real estate?
I'd love to. Thanks, John. So you see the formula on screen here. It's a fairly straightforward formula, just a couple subtractions to get down to the gain, right? So very simple. You start with the gross proceeds on the sale of your parcel of real estate, and that's normally the top line sales price that you agreed to for the sale. And then you adjust that gross proceeds with closing costs. So the closing costs are everything else that's broken down in your closing statement, right? You've got your title costs, all the deed recording type things, your agent commissions, all of that good stuff feeds into the closing costs, and that's what gets down to what we use for net proceeds.
Right.
That feeds that gain on sale.
So one thing important is debt does not count as a closing cost to deduct off your gain. So you don't count debt, but you do count all the other closing cost type items like you mentioned, commissions, recording costs, title costs, any of those sort of costs.
For this purpose, you just completely remove that debt piece out of it and ignore it. So that seems as a common misconception sometimes. And for purposes of calculating the gain, you just remove that piece. So once we have the net proceeds, we're actually going to then deduct the adjusted cost basis in the property from those net proceeds. So the adjusted cost basis is an accounting term. And basically what it is it's your original cost basis in the property. So if you purchased it 10 years ago, it's your initial purchase price back then 10 years ago, adjusted for any significant improvements you've made to that property while you've held it. And then deducted from that is the amount of depreciation expense you've deducted against those that cost basis over the course of while you held that property. And once you get that adjusted cost basis piece, that's what's being deducted from the net proceeds to calculate the gain. Well, after we get down to this gain piece, we get into the different gain buckets and how you actually are taxed on the gain. And that depreciation piece is going to be important here in the next couple slides. We look at that a little deeper.
So basically, to summarize it real quick, you take your gross proceeds, the sales price of the property, minus any closing costs on the sale, and then you subtract your cost base, your adjusted cost basis, which is basically what you originally paid for the property plus any improvements, minus any depreciation that you've taken during the entire time that you've held the property, and then that gets you to your gain on the sale, right? And so now we're going to talk about, we have this gain, but we want to know, okay, how's that gain going to be taxed? And sometimes this isn't really a straightforward answer. And so we're going to walk through, once you have this gain number, what are the different buckets of taxation that is applied to this gain in order to figure out what your ultimate tax is. So why don't you walk us through these various buckets?
Yes, of course. So this is where the gain calculation gets pretty complicated, right? Once you get down to the taxes and how that gain kind of flows into all these different buckets that John's referring to. So I'm going to touch on these briefly, and it's going to be from a very high level, and then we're going to give an example that's going to try to make this a little more concrete. So to start, the gain, you have a gain on your sale of property, right? So that formula we looked at on the last slide takes the gross proceeds and gets down to a gain on sale. Let's say that's a net positive, you've got a gain. Now you take that gain and you throw it into a bunch of different tax buckets that get down to how we actually calculate that tax that you're going to end up paying. So the first bucket I'm going to touch on is called 1245 recapture. And 1245 recapture is simply the 1245 is the code section that kind of governs how this works. And in the most basic terms, it's just recovering that depreciation that you've deducted previously while you held that property. And so you got an ordinary tax deduction for that depreciation you had taken during the years while you held it. Now the IRS says, okay, we're going to tax that piece of gain to recapture that depreciation piece at ordinary rates as well.
Right. And so 1245 only applies to personal property. So in the bonus depreciation environment, which we're going to talk about ad nauseum whenever we talk about acquisitions of real estate, you have accelerated depreciation on 5 and 15-year properties. So then when you turn around and sell it, you have ordinary gain instead of capital gain on that portion of that gain.
Correct. Thanks for the clarification. And so then the piece that's actually for your real property, so the building and the land, is generally going to be taxed then at capital gain rates. And what we encounter first on the building is the unrecaptured 1250 gain. And what unrecaptured 1250 gain does is it takes that on the real property piece, it takes the amount of depreciation you've taken back up to the original cost basis, and that portion of it is going to be taxed at capital gains rates that are treated a little bit differently. It's at a maximum of 25%. So from there, after you recapture that 1250 piece, then the remaining is what's known as 1231 gain. And so in most cases, that's simply taxed at capital gains rates, which we may be familiar with, that scale from 0, 10 to 20%. And that additional piece on both the building and the land, for land, you don't get a depreciation deduction on that piece. So any portion of the sales price that's allocated to land, which we'll touch on a little more in just a minute here, that building excess and then the gain that's attached to the land is going to be taxed at 1231 gain.
Right. And so 1231 is one of those code sections that's really complicated. I think it was on our tax class final, right? Like the big final on trying to understand it.
Didn't enjoy that exam.
But it's a very favorable code section in that if you have a net 1231 gain, it's taxed as capital gains. And then if you have a net 1231 loss, it's an ordinary loss. So it's a very favorable code section, but basically that is the catch-all for any gains beyond that 1245 recapture and that unrecaptured 1250 gain. So now once you have those three buckets kind of understood and laid out, there are some other nuances to the sale that can have tax consequences. I think the first one is purchase price allocations. So if you think about it on that 1245 recapture, if you own an apartment complex with multifamily and you buy a fridge and you pay $1,000 for a fridge, and then 10 years later you sell that fridge, you need to start thinking, okay, is it fair that the fridge was still worth $1,000? Or is that something that perhaps over time the value has gone down, where maybe I could justify having a lower allocation to that piece of property and therefore would have a lower 1245 recapture on that property because it's really not worth what we originally paid for it. And so that's one of those considerations when making a sale, is how is the purchase price being allocated. 1231 also has a provision in it that is one of those gotcha rules, and that a lot of times you may not think about it, and then you plug it all in.
Always a gotcha.
And it got you. But if you take an ordinary loss because of that net 1231 loss, in the next 5 years, if there is a net 1231 gain, then you would actually have to pick that up as an ordinary gain instead of a capital gain. And so, Kyle, you and I have dealt with that even in the last few months when we were trying to plan a transaction, saying, hey, we really need to be cognizant that this is out there because you may not get the capital gain that you think you're going to get. And so we really need to plan around that. The net investment income tax. So if you're passive and your income exceeds certain thresholds, then they add a 3.8% tax on top of your capital gains. So instead of it being 20% capital gains, it would be 23.8% capital gains. We work with a lot of real estate professionals to make sure that they're accounting for net investment income tax correctly. In general, if you're a materially participating real estate professional, capital gains on the sale of real estate is not taxable with net investment income tax, and you can get out of that tax. Finally, the passive activity rules. So if you are a passive investor, there's certain loss limitations that you could have suspended losses on a property. Well, those get released when you ultimately sell the property. So while you may have this capital gain from the sale of the property, you also potentially could have an ordinary loss to help offset some of your other income. So there's a lot of nuances that come when selling the property. So the best thing I thought we could do maybe is walk through an example, just to help put numbers to things. I think that really helps illustrate the concepts. So I'm going to read off an example, and then Kyle, why don't you walk us through kind of how the tax would be calculated?
Sounds like a
So
plan.
we have this real estate professional, and they sold a building for $1 million. And then for simplicity purposes, we're just going to say that the closing costs are 10%, right? $100,000 covers all the commissions, any other costs that they had, 10%. Well, they originally purchased that property for $500,000 many years ago. And in total, they have $300,000 of depreciation that's already been taken on the property. So you would find that on your depreciation schedule. And of this $500,000 that they originally paid for it, $100,000 of it was tangible property or personal property and was fully depreciated, right? So you have a depreciation schedule of $500,000 of cost basis minus $300,000 of depreciation, but 100 of the cost and depreciation was for personal property. So Kyle, how does that all shake out for the taxes?
So first, we're going to go back to that formula, right, that we talked about on the first slide, and you see on screen now, where we have the building was sold, the gross sales price, top line, gross proceeds, $1 million. Simple enough, pretty straightforward. And then we're assuming, for simplicity, for purposes of this exercise, that 10% of those sales proceeds are closing costs. So you see, that's how we get down to that $900,000 net proceeds number. We just deduct the closing costs in the transaction from the gross proceeds. From then, we're going to deduct the adjusted cost basis from those net proceeds. So as John mentioned, we're assuming here that the property was originally purchased for $500,000 and has $300,000 total of depreciation. And with that, $100,000 of that sales price was tangible property. So for purposes of the adjusted cost basis, we just take the originally purchased $500,000. We're assuming there's been no significant improvements made since that original purchase. There's $300,000 of depreciation has been taken since then as a deduction on the tax return, and we have an adjusted cost basis of $200,000. So we take the $900,000 minus the $200,000 of adjusted cost basis, and we get down to that $700,000 total gain.
Right. So it's a pretty straightforward calculation, and this is something that we do on a regular basis for our clients, is help them figure out, okay, what's your sales price, what's your closing cost, here's your adjusted cost basis, here's what your gain on that sale would be. And then in our example, how does that all shake out into the various buckets?
All right, so then we get into the fun stuff, right? This is where it really gets exciting. So we have the first $100,000 goes into that 1245 recapture piece. So as John mentioned when he outlined the problem, $100,000 of the purchase price was allocated to tangible property, which was fully depreciated. So we had gotten an ordinary depreciation deduction on that tangible property while it was in service and we were using that property. So the IRS says when you have a gain on the sale, you have to recapture that depreciation piece, and that's taxed to ordinary rates. So we're assuming in this exercise, the top gain rate at that time is going to be 37%. So $37,000 is the ordinary income. The 1245 recapture piece, that's recapturing the depreciation deduction we've taken on the tangible property. Then in the next bucket, we have to recapture that remaining depreciation that we took on our real property. And so that's where we get into that 1250 code section bucket, where we had taken $300,000 total of depreciation, but $100,000 of that was for the tangible property. We had $200,000 left over that we took on the building itself. So that is taxed at the unrecaptured 1245 gain rates, and that caps at 25%. So a little closer to that 20% capital gains rate you see for the exercise, but still it's a beneficial rate, but you still have to recapture that depreciation piece. And so for that purpose, we got $50,000, that piece, we had $50,000 of tax. And then the remaining $400,000 in excess is taxed at that 20% capital gains rate. And so you see there you have the ordinary recapture piece at 37%, then we get down into the capital gains rates, which tend to be more favorable. So in any way that you can allocate a larger portion of your sales price, to that 1250 recapture bucket, the 1231 gain buckets, you're going to be taxed at more beneficial rates.
Right. And so then really what you get down to this $167,000, you know, for quick fun, I kind of said, well, what's kind of the effective rate? And it ended up somewhere around 24%-ish. So that basically helps you kind of figure out, okay, I sell this building for $1 million. What am I going to pay in taxes? Well, there you go. There's how we make these calculations. So hopefully this helps unravel a little bit of that mystery. So hope you can join us for our next video when we talk about the purchases of real estate. We look forward to kind of going over that and some considerations there. And Kyle, thank you so much for your time and help kind of going through all of this.
Thank you, John. As I said, love this stuff. Have a great time doing it. So happy to be here. Thank you.
All right. Thanks, guys.
To learn more about James Moore & Company's real estate accounting and business solutions, go to JMCo.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.